But I don't think there's any crisis on the horizon. You've seen the people talking about how the Treasury market's in trouble or how stocks are going to sell off dramatically, and neither one of these things has happened. Most of the financials have been coming back since about the second week in November, and I expect that to continue.
Hey everyone, welcome back to another episode of The Wrap with Chris Whalen. Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst blog, the very best independent analyst that you will find on Wall Street, and a friend of the show. So great to see you again, Chris. We missed last week because of the holiday, and a lot of folks missed you, so I'm just thrilled to have you back.
Oh, good. Well, good morning, Julia. We got to take holidays. That's why we have them.
That is true. And the fans certainly love you, and they are loving this weekly recap that we're doing here. Okay, let's start with the Federal Reserve because we have the FOMC coming next week. And I guess where I want to start with you is it seems like most folks are now expecting Kevin Hassett to be the next Fed chair pick. I know you've been talking about Hassett for a while, so I'd love to get your latest thoughts there. How do you see that playing out?
Well, Kevin Hassett, I think, has had this in the bag for a while. The Trump administration and Treasury Secretary Bessent, I think, were just teasing the possibility of others. But really, Fed chairmen tend to go through the White House, either the Council of Economic Advisors or the NEC, and they also have to be on a good basis with the president. The president has to believe, at least, that they will be loyal to him once they go in. We have many examples where that's not the case, probably most famously with Harry Truman and William McChesney Martin. But I think, Kevin Hassett is known as a very smart, very politically astute guy. He's been operating in Washington for decades at American Enterprise Institute. And, I expect him to be a good Fed chairman. Is he going to give Donald Trump everything he wants? No, because as soon as he's confirmed and he walks through the door into the Fed, things change. And he will have to operate by consensus the way all Fed chairmen do. Fed chairmen don't like to lose votes on the FOMC. So he always wants to be in the majority. And I think that right off the bat, he's going to have to figure out how to work with Mickey Bowman, who's turning out to be a very strong vice chair for bank supervision. And, there are other players on the committee. What's interesting, Julia, is whether or not the Trump administration is going to allow Reserve Bank presidents to be re-upped in February. They all end their terms at the same time. It's one of the quirky aspects of the Federal Reserve Act. And if they want to withhold that approval, then the FOMC would just be 7 governors.
Right. Sorry, that is a quirky dynamic. Explain that. That's interesting.
When the boards of directors of the Federal Reserve Banks around the country, there are 12, nominate a new president, they have to get that decision approved by the Board of Governors. This was one of the reforms that Franklin Roosevelt put in place in 1935 when he centralized the central bank in Washington. There wasn't originally a Board of Governors in Washington. You just had the 12 reserve banks. And I kind of would like to see us go back to that. I've got an article coming out soon in the International Economy magazine that talks about this. But the politics here are interesting because if the Trump White House doesn't like a Reserve Bank president who's nominated, then they don't have to approve them.
Would it make sense though to go back to go to 7? I'm not so familiar with the inner workings or if this has happened before, but
no, it hasn't. Remember during Trump 1 when they didn't fill some of the governor spots and the board didn't have 7 members? This is a little different because the Reserve Bank presidents rotate as voting members of the FOMC. So what you could see happen is if they don't like the candidate that's proposed by one of the reserve banks, then, Kevin Hassett could say no. Now, Powell will still be in office in February, so he can reapprove most of them. But the politics of this get to be very interesting.
Yeah.
The Trump people want rates to come down before the midterm elections. There are a lot of questions about whether the Republicans can hold the House. The Supreme Court just approved the new redistricting law in Texas, by the way, which was a big win for the Republicans. So, the whole dynamic here is different from the general election when Trump was clearly the favorite. Now you've got a lot of issues like affordability and immigration and all the rest of it. Even the World Cup next year is getting thrown into the mix. So there's much more uncertainty about how the midterm elections are going to go. And I think that's going to put even more pressure on Hassett and the Fed to give the president what he wants in terms of interest rates. Because, the economy is okay, but if they could get mortgage rates down to 5.5 or 5.25, that'll make a big difference in the election.
Mm-hmm.
Right now we're at about 6.25. So it gives you a sense of how far we have to go.
Yeah. Gosh, it's so interesting. They often talk about the Federal Reserve being independent, but what I'm hearing is it's very much political. It is a political entity. It matters a lot.
The Fed can't be independent, Julia. The governors of the Fed are basically the bankers for the Treasury. The Treasury is the borrower. The Fed is the lender. And the Fed sets the rates at which Treasury ultimately operates in the marketplace. The fact that the president appoints the governors of the Fed means by definition that they're not independent politically. And the real issue, of course, is that the Fed cannot be independent of Congress. Congress authorizes the Fed. And the Fed is really the alter ego of the Treasury. It's kind of the opposite of the Treasury. The Treasury issues liabilities, Treasury bonds, and the Fed treats those as assets. It's kind of a cool leisure domain, right? So the Fed is essentially a screen behind which the federal government operates, and it's a buffer that provides liquidity to the market. That's why we have it. We had 3/4 of a century when we didn't have a central bank in the U.S., and the Treasury was the only game in town. We could do that again, but it would be very disruptive to the economy.
Mm-hmm. Yeah. Just going back to the notion of Fed independence and Hassett, you also draw a parallel to Truman and William McChesney Martin as well.
Yes.
So I guess your take here is that Hassett would pivot from being a Trump loyalist to prioritizing his legacy once he's confirmed.
I think he'll do a little of both. Hassett is going to give a Republican president what he wants. There's no question. But the question to me is, how do you get there? Mm-hmm. Do you do it, tomorrow, the way Donald Trump would like it, or do you take a more gradual approach that won't disrupt the markets? Because you've already got the talking heads yammering about Hassett and how he's going to be a disruptive factor in the bond market and the stock market and all the rest. I don't think that's true. Kevin Hassett is a very smart guy, and he's an extremely skilled and veteran political operative. He's been in Washington most of his career. So I think, he'll do the right thing by Donald Trump, and he'll help the Republicans win that election. Fed chairmen always do this. Remember Ronald Reagan. Okay, Paul Volcker waited to fight inflation to make sure that Ronald Reagan won the election in 1980. So this whole notion of Fed independence to me is a crock. I've always laughed every time people say this because I grew up in a house with my dad who was an advisor to Fed chairman. They came to our Christmas party. So I just think, you can't ignore politics in any aspect of Washington. It's just a given.
Yeah. Okay, so we have the FOMC next week. I think the last couple of times you and I had spoken, the Fed minutes had just come out. It was showing the lack of consensus, the gridlock amongst the members. And now that we've had a bunch of Fed speak since then, the odds of a rate cut, they're pretty high now. I think it was last I checked on FedWatch, let's see, 87%, I think is, don't quote me on that. Yeah. But it's most likely, I think the market's certainly pricing in a rate cut. Curious how you're thinking about the Fed. Does a rate cut make sense?
They have been on the fence a bit, but I think the jobs numbers and some of the reports of layoffs that have been coming along in the media are making members of the board a little more, I think, supportive of a rate cut because they're worried that the next job number they get is going to be sharply down. And they don't want to be criticized for being late to the party. The Fed always has this risk, which is that the month-to-month statistics that they rely on to make policy can sometimes be quite volatile. So, for example, after COVID, you saw the board maintain purchases of securities and keep policy very loose for too long. And that created problems. Now they've been through a period of tightening and everybody's saying, well, you got to loosen up now. We need to get mortgage rates down at least a point from where they are today. Think of that as the most important political measure of the Fed. Where are 30-year mortgage rates? Because nobody knows what Fed funds is. That market barely exists anymore. But everybody definitely knows where 30-year mortgage rates are. And consumers, Julia, are so sensitized to price. They are so sensitized to whether or not they can go out and refinance and save a couple $100 a month on their mortgage payment, that it's become an extremely important political issue. So that's why I think you'll probably see a quarter point cut. The board is going to move slowly. They don't want to lose credibility. If you gave Donald Trump a half point, I think everybody would criticize him for that. So they have to kind of walk a very narrow line that maintains their credibility on the one hand and also buys a little bit of insurance to make sure that we don't see bad job numbers at the end of the year and in the first quarter. And then everybody would turn and say, oh, you guys waited too long. So it's a tough thing that they have to balance.
Hey there, I just want to take a quick moment to thank you for watching this video, and I would really love for you to subscribe to this channel if you like this content. Over 70% of our viewers are not yet subscribed, and we are on a mission to hit 100,000 subscribers. So if you could, just take a quick moment, hit subscribe. Thank you so much for your support. We appreciate you, and back to the video. As you mentioned, the mortgage rates are what's really important to pay attention to, not the Fed funds. And earlier in the conversation, you were saying to get to 5.5 from where we are 6.25 right now, a little bit north, that's a big difference. So I would love to just maybe hear a bit more on the importance of the mortgage rates. Do you see a viable path to get to 5.5? What happens if we get there? What would that mean? I would just love to hear more on the mortgage rate side of things, because I feel like you're the guy to talk to about this, but I don't really see it in the regular financial media. Exactly.
As we've talked about before, Julia, lenders set coupons on mortgages. So most lenders today are looking forward to a Fed rate cut, and they believe that that's going to help the Treasury market come down in terms of yields, which in turn is going to make their production more profitable. If you think about a mortgage lender today, when they take an application from a customer, they're not going to close that mortgage for 3 or 4 weeks. So they're not going to be able to sell that loan into the secondary market, which is obviously governed by the yield on the 10-year Treasury bond. And the spread between mortgage rates and the yield on that 10-year Treasury determines to a large degree what the profitability is for those loans for that lender. Or really, in many cases, how much money they're going to lose. Because lenders will often lose a little bit of cash when they sell a mortgage after they've closed your purchase. Say you're buying a house. But they make it up because they keep the servicing asset that goes with the mortgage. And over time, they make money. So the key thing is, how aggressive are lenders going to be today and going into the end of the quarter in terms of anticipating that Fed rate cut next week, and then perhaps future cuts in the first quarter of next year. If they believe that that's what's going to happen, they're going to push rates down right now because they want to capture those loans. It's a very competitive market today in mortgages. A tiny fraction of a few basis points can be the difference between you getting a loan and your competitor getting a loan. So if you look at people like PennyMac, United Wholesale Mortgage, Rocket, they're all head to head. Now, what's interesting to your question is that refinance mortgages have been coming back. As rates have fallen and people see an opportunity to save a little money, they're willing to refinance. If we get a quarter or a half point decline in mortgage rates, you're going to see the volume of refinances start to jump. Those are much more profitable loans for lenders than a purchase mortgage for a first-time home buyer. The cost could be less than half. So that's why they love that business. When rates fall, the portion of the total volumes that are attributable to refinance as opposed to a purchase loan start to increase very rapidly. We're going to do $2 trillion worth of mortgages this year in 2025. But if rates fall, we could get that number up to 2.5 or 2.75 trillion. And that means the industry is going to make a lot of money. Realtors are going to make money. And guess what? That's good for the economy.
I was going to say it's a huge part of the economy.
Yeah, and that's good for the Republicans for the midterm elections.
Yeah, that's a really good point. Okay, so let's talk about the economy. There has been a lot of discussion lately about the state of the economy, this K-shaped economy, just from where you sit and what you're looking at. And I should also note, normally, Chris, we would have a jobs report today. The schedule is definitely off right now. But usually you and I would be talking after like the NFP number would come out on a Friday.
Right.
But yeah, just what's the state of the economy from where you sit today? What are you paying attention to? What's concerning? What's actually maybe more of a rosy outlook for you?
I think it's more of the same. Most of the economy is doing well. The bottom quartile is still getting beat up, and that's what you hear the Democrats complaining about. But I don't think there's any crisis on the horizon. You've seen the people talking about how the Treasury market's in trouble or how stocks are going to sell off dramatically, and neither one of these things has happened. In fact, as we noted in the wrap that we put out this morning for our subscribers, most of the financials have been coming back since about the second week in November. And I expect that to continue. The banks the same way. They sold off kind of right after Halloween. You had all the kerfluffle with Bitcoin and the rest of it. But, the leaders in the group are coming back pretty strongly. So I think everyone who's waiting for some kind of, economic break or market break are probably going to be disappointed.
Okay. So they're probably going to be wrong then. You mentioned crypto.
Well, disappointed, not necessarily wrong, right? You don't want to get too personal.
Okay, that's true. That's true. Let's talk about Bitcoin and get some commenters on X and in the comment section talking about crypto. We have seen Bitcoin kind of come back. I don't know where it is right now, but the last I checked yesterday, I think it was above. Where are we today? I don't even know. It was above 90, climbed back above 90. Right. Oh, we're right at 90. It's a little down today. Okay. So I want to hear your latest there because I thought it was interesting in your note. You're kind of playing the crypto trade through SoFi and Robinhood in a way.
Well, I've always believed, Julia, that if you want to play the token game, you want to buy the stock of the enablers. Because the firms who are making money on this are the guys who facilitate the activity. There are winners and losers in Bitcoin every day. By definition, that's what it is. In order for you to make money, you have to take advantage of someone else because there's no intrinsic value in this market. It's just greater fools. So, if you look at Hood, if you look at SoFi, if you look at many of the other players, they've done well. Circle, not so much. The stablecoin game is still kind of a big question mark in my mind. But I think what really is going on here is that the novelty of Bitcoin and some of these other tokens is wearing off. And the only people who really care about it now are Wall Street. The ones who've been doing the IPOs and everything else. The rest of the crowd is, moving on because they always chase the shiny object. And if you look at some of these stocks, they're moving very, very nicely. I mean, SoFi has been the best performing bank stock in the U.S. Lending Club caught up with them, which I thought was very interesting. And again, you look at that and say, are we talking about an economic recession here if people are buying Lending Club? No, absolutely not. When you're buying Robinhood, you're looking at their options volume, which is probably the most important part of their business. And again, they're small investors trading options. That to me is a bullish sign. So, again, I don't see evidence of a terrible, cathartic kind of economic downturn here anywhere soon. The margin credit and the rest of the measures for, non-bank financial institutions that we've written about, okay. But again, I don't know that that's going to be a source of some kind of systemic break. I doubt it.
Okay. Totally separate. Like you're saying, like the kind of retail consumer investors, they're fine. Like when you look at what's happening with, as you mentioned, SoFi, Lending Club, Robinhood, those things. But it's the commercial side. That's what we've talked about, that kind of silent crisis.
I know. The gift that keeps on giving.
So we should talk about a few areas in commercial. I actually this time I'm going to start with the commercial real estate, maybe more of like a reality check there. It seems like there kind of has been this recovery narrative out there. I don't know. But what's the latest on the commercial real estate? Like, what's the real story?
New assets that are located in attractive locations are doing quite well. They're attracting new money. But then you go down to Florida and you look at some of these projects that have been underway for a couple of years. And what's happened is inflation in terms of costs to build are starting to really hurt them. Because, they came out, they talked to their bankers and investors 2-3 years ago and said, this is what it's going to cost to do this project in Miami. And this isn't just northern Florida. This is all over the state. You probably have half a dozen or more significant projects down there that are going to go to foreclosure. And that means the banks are going to end up owning the deal. Likewise, if you look around the country, the big cities are still getting shellacked when it comes to some of these existing office properties that have been marked down 50, 60, 70% in some cases. We mentioned one in Los Angeles, the Wells Fargo Tower.
Yeah.
Yeah, my God, the $500 million default on the mortgage, they're going to auction that property off for a third of what it was valued at 5-6 years ago. So there's really two different stories here with commercial real estate. The new stuff, everybody wants new, right? Whether it's single family homes or commercial. But the existing assets where the use case is kind of a question mark, you got to be real careful with those. And I think you're going to continue to hear about this. Brookfield is one of the bigger players. You have Paramount Group that was acquired by Rhythm Capital. These guys own beautiful properties in major cities around the country, particularly New York, Chicago, San Fran, Los Angeles. But the question is, what are we doing with these assets, Julia? What's the use case for an office building? Imagine the office buildings around JP Morgan's new headquarters on Park Avenue. This, beautiful building, right? He's been renting space in the buildings all around that property. So as he moves his team into his new building, what are we going to do with the old ones? Okay. I used to work for Bear Stearns, 245 Park, a lot of square footage in that building. What are we going to do with it? So there's still a big question mark about what do we do with these older assets, and can we, for example, turn them into residential? Yes, in some cases, but you've got to be very imaginative. Think of a building with X amount of square footage. To turn it into resi, you've got to bring windows and lights. Yeah, I was going to say windows,
yeah.
Oh, yeah. So you could end up losing a third of the square footage of the original building.
And then doing all that plumbing and stuff too, yeah.
No, but you've got to put light shafts. You've got to do things that allow you to put residential occupants in that building, and it changes the nature of the building, and it's expensive. Mm-hmm. So that's really the bottom line. I think commercial is going to be, a hodgepodge. Some of it's going to be good, some not. And you see the same thing in private equity and private credit. Everybody is trying to put lipstick on that pig. And it's tough because, it's probably 15% of private equity companies in the U.S. today have been paying in kind instead of, paying money on their debt. They're basically insolvent. And eventually the funds that control these assets are going to have to admit that they're not working.
Okay, on the private credit side, who's right? I mean, there have been a lot of folks kind of coming out and trying to dispel some myths in private credit. Who's right? And what's the actual data showing?
Well, the actual data shows what we've always known, Julia. You worked in the business. Public markets are public for a reason. They offer investors liquidity and information. When you have private markets, well, you don't have liquidity, do you? And those assets ought to trade at a discount, but they don't. There was such a crowd of people piling into that trade over the last 5-10 years. Endowments, pension funds, everybody thought that they were going to get a better return on their private assets than they would from public assets. And they were wrong. I just spoke with a pretty good-sized pension fund last week that owns shares in a interesting little community bank. The bank's not going to go public for a couple of years. And they wanted to sell their stock, and there's just no way to do it. They contacted the bank and said, hey, can you help us? But the answer is no. So, when you go into private equity, you always have to remember that it's private. And you may end up sitting with that position for a long time before you can liquefy it. But, this is kind of preaching to the choir for me, because when I learned about the securities market years ago, there was a reason we have public markets. It's because retail investors need liquidity. And unfortunately, a lot of firms have been out there telling people a different story, and I think they're mistaken.
Yeah. Chris, do you want to go through what's in the viewer mailbag?
Oh, sure.
Okay. All right. Viewer Greg, he wants to know what you think of the major bank preferred stocks. He says Chris stated not long ago that he thought they would go away because the banks would no longer need them.
I own a lot of preferreds, and they are buying them back. They don't need them. One of the things that Mickey Bowman is doing on the Federal Reserve Board is addressing capital requirements for banks. So over time, you are going to see the major banks, think of the top 10 to 15 that had to issue preferred because they needed additional capital. They're going to buy them back because it's expensive. They can raise money in the equity markets much cheaper. So what I would say is shop around. You want to look at some of the current coupon preferreds and hope that you can keep them. That's really the bottom line. I own a preferred I have two different preferreds from JP, one from Wells. I own the old TRUPS from Citi that they're never going to redeem because they use that for funding their credit card business. Those are grandfathered in as what we call tier one capital for the banks. But I think that, like I say, the banks aren't going to need as much capital. They don't have a lot of demand for loans right now. So, if you're Jamie Dimon, you're going to have record share repurchases next year. And if you're buying back your own stock, you really don't need those preferred securities, do you?
Okay. The next question for you. This is a long one, so bear with. All right. This is from viewer Daniel. And I feel like you're probably the guy for this. According to my research, between 1992 and 2000, CPI averaged at or above 2.5% inflation, 2.6 to be precise. Setting aside the dot-com bubble and the global financial crisis, 2000 CPI, 2002 through 2008, averaged 2.8%. The notion of 2% inflation was a product of fears of deflation post global financial crisis during heavy regulation and anemic Obama-era growth. With federal debt rising, officials felt it incumbent not to let deflation accelerate the cost of debt, and so they targeted 2% as an aspirational in an otherwise deflationary environment. Fast forward to 2017, the Tax Cuts and Jobs Act, deregulation, and a business-friendly growth environment, an aspirational target of 2% was no longer a concern. In fact, it's one of the reasons Powell messaged so poorly in 2018, leading to the sell-off in Q4 2018. My question, why are we, the Fed, stuck on a 2% target when the growth and regulatory environment is not the same as it was in 2009 to 2016 when deflation was the concern? In other words, why does the Fed not recognize that a 2.5 to 2.9% CPI is in line with the modern eras of economic expansion, including the 90s and post-dot-com 2000s?
Well, I think the short answer is that the board understands that this economy needs a little inflation. If you actually had deflation, imagine what would happen. We were just talking about commercial real estate. They assume that assets are going to go up a couple percent in value every year. That's the only way it works. So when you talk to Americans about inflation, they love inflation when they talk about their home or a building that they own. And I think the 2% target was, in a way, the board being honest with everybody and saying, if we get down to 2%, that's okay. Now, your viewer's right about deflation. That's what they were worried about in the past because we were resolving a lot of bad debt. We were taking homes that had been foreclosed. We had commercial real estate default levels up around 10% at one point. So that was the problem, was deflation. Now, not so much. I think they're really just worried about having things like home prices rise by 50% in 5 years. That certainly hasn't been helpful. And then everything else is, healthcare, food, the $12 pound of bacon. What do you say? Homeowners are in shock still when they go to the grocery store and they see where prices are.
Oh my
so
goodness,
I think that's the flip side of this. Powell would have liked it if the central bank could have been helpful there, but central banks don't set prices, Julia. The participants in this economy set prices. You look at rental costs in the major cities, they're still going up dramatically. there's nothing that the new mayor in New York City can do about it either.
Yeah. Yeah, I think you're right. Okay. For folks watching and listening, you can send your questions in every week for Chris. We love them.
Yes,
So
ma'am.
shoot me a note. These are so fun to ask. All right, Chris, let's do a wrap-up question here. You and I, in the last couple of weeks, we've talked about liquidity concerns heading into year end. We've talked about divided Fed policy, struggling private credit, mixed commercial real estate signals, crypto volatility. So a question for you is, what is the biggest risk entering 2026 that markets aren't pricing in, or maybe is not getting enough attention?
The risk is always a surprise. Jerry Corrigan, my old boss at the Fed in New York, said markets suffer systemic risk when they are surprised. So if we get a large default coming out of the commercial space, if you see a hedge fund or a non-bank company that's over leveraged getting into trouble, that's the kind of thing that can cause a sell-off. But having said that, we just went through a sell-off in the middle of November. And after a couple of weeks, everybody got happy again and they took prices back up. So I'm not really that concerned about market risks. I am a little worried about what we're going to see coming out of the credit sector on the commercial side. But you know what? Third quarter earnings, most credit costs for consumers, auto loans, credit cards were going down. That's why we talk about a K-shaped economy, because everybody keeps worrying about something bad. And then they turn around, they look at the banks, and the banks are underutilized and their credit expenses are falling. So that's not exactly a scenario for a recession, is it?
No. Well, okay, just real quick on the K-shape, is it possible to fix that so it's not so, because I think a lot of people, like, if you're on that bottom part, you're definitely feeling it. So is there like a path forward to kind of just fix the economy, reinvigorate so it doesn't feel so divided?
That's why they're hoping for lower interest rates. You know, typically housing is one of the more important parts of the economy when you're talking about growth. And housing's been kind of in a funk for the last several years. So if you get mortgage rates down into low fives, you're going to see a lot of happy home builders and realtors. Remember, the home builders are discounting their inventory right now by subsidizing your mortgage. They'll buy your mortgage down by a point or more to move that house that's sitting there. You and I have talked about the amount of inventory that's sitting in your neck of the woods and all throughout the South. There's been a lot of overbuilding. So you get mortgage rates down, we're going to clear out those inventories, and then everybody's going to go build more houses, which is what they want.
Chris, it's always a treat doing this with you. I love our weekly wrap with you. Before I let you go, let folks know where they can find you, support more of your work, find more of your work, and any parting thoughts, anything that you would like to leave them with to think about as we head into next week for our next wrap with you. The floor is all yours.
Well, no, thank you, Julia. I published the Institutional Risk Analyst. You can find me on X and LinkedIn at RC Whalen. And I also publish a column for National Mortgage News, which is great fun. We just put up a new paper on the Social Science Network, something really geeky about how mortgage lenders finance their operations and their assets that some people may find of interest. And I look forward to our next conversation, Julia.
I do too. Chris Whalen, chairman of Whalen Global Advisors, author of the Institutional Risk Analyst. Really, really appreciate you. And I can't wait to see you next week. Thanks again, Chris.
Thank you.